Don't put all your eggs in one basket. The power of diversification. Imagine you put all your money into one stock. You feel great when the stock goes up. But what happens if the company struggles? You could lose a lot of money. That's where diversification comes in. Diversification means not putting all your eggs in one basket. In investing, it means spreading your money across different assets. This strategy helps lower your risk. When one investment isn't doing well, others might be. Think of it like a balanced meal. You wouldn't just eat one type of food, right? You need a variety of nutrients for a healthy diet. Similarly, a diversified portfolio needs a mix of assets for healthy financial growth. Diversification is key to long-term investment success. It helps you weather market ups and downs. It can also lead to more consistent returns over time. The video is for educational and entertainment purposes only. It is not financial advice. Do your own research and do not invest more than what you can afford to lose. Your investment toolkit, understanding different asset classes. Now that you understand diversification, let's look at the different investment tools available. These are known as asset classes. Stocks represent ownership in a company. When you buy stock, you're buying a small piece of that company. Stocks can offer high growth potential, but they also come with higher risk. Bonds are like loans you give to governments or companies. They offer regular interest payments and are generally less risky than stocks. Cash includes your savings accounts, money market accounts, and short-term government securities. Cash is the least risky asset class, but it also offers the lowest potential returns. Real estate can be your home, rental properties, or even land. Real estate can be a good investment, but it can also be illiquid, meaning it's hard to sell quickly. Commodities are raw materials like gold, oil, and agricultural products. Commodity prices can be volatile, but they can also offer a hedge against inflation. Alternatives include investments like hedge funds, private equity, and venture capital. Alternatives can be complex and are typically only suitable for experienced investors. Each asset class has its own risk and return profile. Understanding these differences is crucial for building a diversified portfolio that meets your needs. Zooming in, why diversifying within asset classes matters. Diversifying across different asset classes is important. But did you know you should also diversify within each asset class? Think of it this way, you wouldn't want to invest all your stock money in just one company. What if that company faces unexpected challenges? Here's how to diversify within asset classes. For stocks, invest in companies of different sizes, large cap, mid cap, small cap, and sectors like technology, healthcare, and energy. Consider international stocks for broader exposure. For bonds, invest in bonds with varying maturities, short-term, intermediate-term, long-term, and credit qualities like government and corporate bonds. For real estate, don't put all your real estate eggs in one basket. Consider diversifying geographically or by property type, residential and commercial. Diversifying within asset classes provides an extra layer of protection. It helps reduce the impact of any single investment on your overall portfolio. Building your dream team, strategic and tactical asset allocation. Now that you know about asset classes and diversification, how do you decide how much to invest in each? This is where asset allocation comes in. Strategic asset allocation is like creating a long-term plan for your portfolio. It involves determining the ideal mix of asset classes based on your time horizon, risk tolerance, and financial goals. For example, a young investor with a long time horizon and higher risk tolerance might allocate more to stocks. A retiree seeking income might allocate more to bonds. Tactical asset allocation is about making short-term adjustments to your portfolio based on market conditions. For example, if you believe stocks are overvalued, you might temporarily reduce your stock allocation. Remember, asset allocation is not a one-time event. It's important to regularly review and adjust your portfolio as your circumstances change. From plan to action. Implementing your diversified portfolio. You've learned about asset classes, diversification, and asset allocation. Now it's time to put your knowledge into action. Here are the steps to building your diversified portfolio. First, define your financial goals. What are you saving for? Retirement? A down payment on a house? Knowing your goals will help you determine your time horizon and risk tolerance. Next, determine your asset allocation. Based on your goals and risk tolerance, decide what percentage of your portfolio to allocate to each asset class. Then choose your investments. Select specific investments within each asset class. You can do this by researching individual stocks and bonds. Or you can invest in mutual funds or exchange-traded funds, also known as ETFs, that provide instant diversification. After that, open an investment account. You can open an account with a brokerage firm, a robo-advisor, or directly with a mutual fund company. Finally, invest regularly. Make investing a habit by contributing to your portfolio regularly, even if it's just a small amount. Remember, building a diversified portfolio is a marathon, not a sprint. It's about making consistent contributions over time and letting the power of compounding work its magic. Staying on track, monitoring and adjusting your investments. Building a diversified portfolio isn't a set-it-and-forget-it task. You need to monitor your investments regularly and make adjustments as needed. Here are some key things to monitor performance. How are your investments performing relative to their benchmarks? Asset allocation. Has your asset allocation drifted from your target due to market movements? Risk tolerance. Has your risk tolerance changed due to life events or market conditions? If your portfolio needs adjusting, you can rebalance. Sell investments that have performed well and buy investments that have lagged. This brings your portfolio back to its target asset allocation. Reevaluate your risk tolerance. If your circumstances have changed, you might need to adjust your asset allocation accordingly. Regular monitoring and adjustments help ensure your portfolio stays aligned with your financial goals. It also helps you avoid making emotional investment decisions. The future of diversification, AI, blockchain, and cryptocurrencies. The investment landscape is constantly evolving, and emerging technologies are playing an increasingly important role. Artificial intelligence, or AI-powered robo-advisors, can help create personalized portfolios, automate trading strategies, and identify investment opportunities. Blockchain. Blockchain technology can improve transparency and efficiency in financial markets, potentially leading to new investment opportunities. Cryptocurrencies. Cryptocurrencies like Bitcoin and Ethereum have gained popularity as alternative investments. However, they are extremely volatile and risky. While these technologies offer exciting possibilities, it's important to approach them with caution. Carefully research any new investment before adding it to your portfolio. Attend seminars and consult with financial experts to stay informed about these rapidly changing technologies. A balanced approach, combining traditional and modern assets, can help mitigate risks while taking advantage of new opportunities. Regularly monitor your portfolio and adjust your investments based on market trends and technological advancements. The power is in your hands, taking control of your financial future. Building a diversified investment portfolio is one of the most powerful steps you can take towards achieving your financial goals. By understanding asset classes, diversification strategies, and asset allocation, you can create a roadmap for your financial success. Remember, investing isn't just for the wealthy. It's for anyone who wants to grow their wealth over time and achieve financial security. Start small, stay disciplined, and never be afraid to seek help from a qualified financial advisor. The power to create a brighter financial future is in your hands. Start building your diversified portfolio today. Glossary of investment terms, asset class, a group of investments with similar characteristics such as stocks, bonds, or real estate. Diversification, spreading your investments across different asset classes to reduce risk. Asset allocation, deciding how much of your portfolio to invest in each asset class. Strategic asset allocation, creating a long-term asset allocation plan based on your financial goals, time horizon, and risk tolerance. Tactical asset allocation, making short-term adjustments to your asset allocation based on market conditions. Rebalancing, selling investments that have performed well and buying investments that have lagged to bring your portfolio back to its target asset allocation. Special thanks to Wikipedia for providing a structure of knowledge. Thank you for watching our channel. If you found this video helpful, please like, subscribe, and hit the notification bell for more insightful content. Stay tuned for our next video.